So the markets are overvalued today, but there are still decent companies that are interesting today as well. So in today's video, I'll be covering the market's overvaluation as well as what to buy in this overvalued market. So for reference, this is my entire portfolio here. I update this weekly, and I actually did some buys this week as well into some decent companies that I'll be sharing later on. But let's talk about the market valuations first. So the markets are overvalued by most metrics. So for example, you have the trailing 12-month PE over here. And as you can see, the markets are approaching around a 30 times of earnings. We're currently now around a 29 times of earnings, which is historically on the higher side. So in April, we dropped to around a 23 times of earnings. And currently now we're back up to pre-April levels, which is around a 30 times of earnings. Over the past 5 years, the only time we reached a higher level than this was in 2021, when we had the bubble, when we had all the different random meme stocks going up. We're currently seeing something similar as well, although to a lesser extent. On a going forward basis, the market is expensive as well. So the only time we reached this level was again in 2021 and in the dot-com bubble. So during the dot-com bubble, market valuations were around a 24 to 25 times forward earnings. So that's around a 10% more to go until we reach similar levels. So the market is by trailing 12-month PE as well as your forward earnings look overvalued today. But there are some counter arguments to be made as well. Some investors will claim that the markets are not overvalued because of this PEG ratio here. So PEG is basically your price to earnings divided by your growth. So the lower the better, the lower the cheaper the market will seem. So for example, the PEG now is at a 1.3 times. So what that is signaling is that although the markets are at a 22 times of forward earnings, the markets are actually growing a lot faster than your typical markets. And that is why the markets look undervalued based on this PEG ratio. But you should take this PEG ratio with a pinch of salt as well, because your PEG ratio only stays if the growth is sustainable. And more often than not, analysts will project the growth way too high or way too low. So this could mean that this PEG ratio over here is actually making the market's a lot less overvalued as compared to what it seems, because analysts are optimistic in general. So we'll be covering some quality stocks that are still decent buys right now, some of which I've added to. And the first company that I'll be covering is actually United Healthcare. So I haven't added to this one, but I think the company is still decent today. United Health is down 30% year to date, currently trading at a 15 times of earnings. So for United Health, the thesis is simple. This year is an exception. Next year will be a back to growth year, and then the following year will be a normalization year. So the markets are now pricing in the fact that United Health can grow its margins next year, which is what we've been saying for a very long time. So for United Health, Warren Buffett, he added to his initial position at $320 a share. David Tepper added at around $380 a share. So currently now at around $360 a share, you're still adding at their entry prices. So for United Health today, I think this is one company that will probably recover like what Meta did back in the days. It will recover back to all-time highs, but it will just take some time for the fundamentals to recover with it. So it's quite fascinating to look at the sentiments as well. At this point, everything was well for United Health. It went down, it dipped down here, and then went back up to all-time highs again, and then everything was great. And then once it crashed 40, 50% all the way to this point, no one wants to stop. And currently now we're seeing a reversal with the sentiments as well. So with sentiments heading in a positive direction, I think the lows for United Health is more or less gone already. But the company is still significantly below its all-time highs. And for this company, it's a quality company in your healthcare sector, which was heavily hit over the past year or so. So for United Health today, I think it's still a decent company if you're looking to add. And for now, I'm holding on to this one. Next company that I'll be covering as well is S&P Global. So S&P Global year to date is down around 3%. It is currently trading at a 36 times of earnings. So for S&P Global, if you were to look at the guidance from the last earnings report, the guidance were quite decent overall. So revenue growth of 5 to 7%, and then EPS growth of around 18% because they're divesting a portion of the business. So if you were to remove the divestiture, that would lead to around a 13% EPS growth for this company, which is quite decent overall. I mean, the company is a stable compounder that gives you 13, 14, 15% growth every single year, and stable growth as well from this compounding machine. So for S&P Global, if you're to look at the growth profile for this company, this is the revenue chart. So revenue has been growing steadily throughout the years, and it's hard to find a company with a similar growth profile in terms of revenue as compared to S&P Global. So for this company as well, your interest rate cuts are underway. So the Fed has just recently lowered your interest rates. So when interest rates are lowered, what that means is your borrowing costs will start to fall. So that will encourage all these corporate companies to go and take on more debt, which means there's more ratings required, which means the S&P Global volumes, their rating volumes will probably increase when these interest rates come down. So for S&P Global, adding on to the fact that your interest rates are cut, I know I sound like a broken record on this one, but you have the debt wall maturity coming up as well in 2028. So from now till 2028, we'll be seeing increases in terms of your debt wall maturity, which means that more ratings will be needed to basically raise more debt. So what that means is the volumes for S&P Global will increase here on out till 2028 at the very minimum. And if you're to add the interest rate cuts as well, this would mean even more volumes for S&P Global, which is overall a positive for the company. So this could serve as a catalyst for the years to come. You could see a lot more growth in terms of earnings. The company is able to execute well. And for S&P Global, the valuation today is not unreasonable as well. So on a price to free cash flow basis, the company is trading at around a 27 times price to free cash flow, around the median in these 6 companies here. So I included S&P Global, Moody's, ICE, Equifax, Nasdaq, as well as MSCI. S&P Global is currently in the middle. Its nearest competitor, which is Moody's, is currently trading at a 36 times of price to free cash flow. So we can see the valuation discrepancy there. I think for S&P Global, it's probably the better company to look at if you're looking for a company in this credit ratings portion. And that's why I added to my position a few days ago as well. This company is a quality business that will compound for many, many years to come. Next company that I'll be covering as well is Equifax. So Equifax year to date is now around 8%. It is currently trading at a 45 times of earnings. So for Equifax, the reason why it is down is because FICO is up. I mean, quite literally. So FICO is up around 15% over the past few days because they introduced a new pricing structure. So this is what they did. FICO basically introduced this direct license program whereby lenders can now come to FICO directly without passing through your credit bureaus. So for all the lenders with existing data of their consumers, if the consumer comes to them for a second time or third time to borrow money, then all these different lenders, they don't have to pass through the credit bureau route anymore. They can go direct to FICO, they can save money on that portion, and FICO will be able to expand its economies as well. So for example, FICO currently makes around 15% of the total tri-merge cost as royalty. But what FICO has done here is simply incredible. What they've done is they've jerked up their prices. So they have 2x their prices, and they've shifted all the blame to all these different credit bureaus. So the credit bureaus are the ones that are marking up all these FICO scores. And what FICO is doing is incentivizing all these lenders to come directly to it, to save costs, all while this company, FICO, is able to increase its earnings as well. So currently now, around 20% of loans are from repeated consumers. So what this means is at least 20% of the volumes that used to go to Equifax will go directly now to FICO. So on a weighted average cost basis, we're basically seeing an increase in FICO score pricing around 20% if you're to do the math as well. So this is an amazing move by the management. And if you're interested in reading all into this, I actually made a write-up on FICO on this Substack account. It's called Helios Capital Partners. Feel free to check it out for the entire thesis for FICO, as well as the updates that came after this report on 2nd of October. So for Equifax, on the other hand, this company was actually hit because of FICO's new pricing model. So currently now, around 3% of the total net income will probably be hit. This is assuming that the other businesses remain intact. So I think for Equifax, the beauty of the business is actually not in this credit bureau portion. The credit bureau portion is generally a weak business because it is cyclical, it is prone to regulations and so on. The amazing part of this business, Equifax, is under this workforce solutions portion. So for Equifax, I think the news was sort of like an overreaction. Only 3% of the net income will be hurt, but the stock fell by around 12% from peak to trough because of this news itself. So we'll talk about this workforce solutions portion, which is the incredible portion of the business. So what this workforce solutions does is it sells employment data to many different firms. What the company has shown over here is the ability for Equifax to basically expand its total addressable market. So currently, most of your employment verification data is still manual, still physical copies, it's still paper. But what Equifax is trying to do is to try to shift people from using those papers to basically use their online platform. And besides that, Equifax is currently the biggest in this employment data portion. And for employment data, it is typically sensitive as well. So people will only want to share it to one portal. And what they've done is they've shared it to Equifax because once your employment shares the data on this Equifax workforce solution platform, you'll be able to have a request for another employee's data as well. And the likelihood of them being able to find on this Equifax workforce solution will be a lot larger as compared to another competitor. For this portion of the business, the work number, it is basically a self-fulfilling loop. And if you were to look at the pricing model of this company here, if you were to look at the workforce solution and the amount of pricing power that the company has exercised, it is incredible. I think the markets are not pricing this in today, and this company is interesting at this price. Last portion, I'll be covering some questions left in the comments. So the first one, it says, what are your thoughts on Chinese tech companies after the recent rally? Are Baba Baidu still buys after going up 35% and 48% in a single month? What are your thoughts on BYD and Xiaomi as well? I think Xiaomi is decent. I think BYD is a company that is operating in a very competitive segment, so I would avoid BYD as a whole. As for Baba, it was a company that I considered. I decided against buying into the company simply because the retail portion of the business is not very strong. The company has been losing share over the years. Baidu, for example, is not a quality business at all. It was a company that was trading at a very cheap valuation before the rally. So maybe it's going up because of reversion to the mean. But of course, I think Baidu, it's a company that is losing share. It's basically the Google in China, but it's losing a lot of market share to other search platforms as well. And the AI portion of the business is a very small portion of the entire business. And the stock has been going up like crazy because of that portion of the business, which is unjustified as a whole. So for me, I think all these Chinese companies, they were cheap maybe a year ago. Currently now they're around fair value. So I would resist against adding to all these different companies, especially after all these parabolic moves here. Next question, it says, great video. Since you have ASML in your portfolio, do you think it's the best time to sell the stock since it hit near all-time highs? So I think ASML is a company that is probably a bit overvalued today. My fair value for the company is between $850 and $900 a share. Company now is trading at a 36 times of earnings. I think this company deserves closer to a 30 times of earnings. So the stock is a bit overvalued today. But of course, it's one of the most monopolistic companies out there. And while the China risk still probably maintains, a lot of the developments over the past month has pushed the stock price up. So you had the government investing in Intel, bailing Intel out. You had all your other developments as well from TSMC and so on. So for ASML, I think it's a quality business. I don't think I'll be trimming this one anytime soon, unless the valuation gets a bit too high. So for now, this is a hold for me. I hope you guys have found this one useful and invest. See you.